Hello and welcome. Thank you for joining today's webinar, Doing Business in the U.S. New Sales Tax Changes. My name is Sarah Larson and I'm the Marketing Manager here at Invest Buffalo Niagara, the Buffalo Niagara region's economic development organization. Joining me are two guest presenters, Andrew Toth and Tom Mazurek, both CPAs with Tronconi Segarra Associates, whose mission it is to provide the best and most appropriate professional accounting, auditing, tax, and consulting services in the industry. Andrew and Tom are two partners we often work with here at Invest Buffalo Niagara when a company is interested in expanding to our region. Andrew and Tom are here today to talk about changes to the sales tax here in the States for just about any company doing business in the U.S. These recent changes are in response to the Wayfair court ruling this past year. They will help us understand some key guidelines, what you really need to know, and how to make sure your company is compliant. And if you still have questions, they can answer them at the end of this presentation. Before we begin today, just a little housekeeping. If you do have questions during the presentation, please type them into the question box in your GoToWebinar control panel. Following this presentation, you will receive an email with a follow-up document that will help you with the changes you will learn about today, provide you our contact information, and a link to our website with expansion tools if that is something you may be considering. So, without further ado, I will turn the presentation over to Andrew and Tom.
Okay, to begin our discussion today, I'll cover some tax basics and/or misconceptions that many foreign businesses have when doing business in the U.S. I'll then cover the standard that was used by states to determine sales tax obligations prior to the U.S. Supreme Court decision in June of 2018. And this standard is still in effect today, which was physical presence. And then I'll turn it over to Tom to discuss the new standard, economic presence, which most states have now adopted. One of the major misconceptions we find with inbound businesses is that they have been advised that they have tax treaty protection for the business they will conduct in the U.S. Well, this may be true for U.S. federal income tax. It is not true for state income and state sales taxes. The individual U.S. states are not a party to the U.S.-Canada tax treaty. A foreign business may still indirectly receive state income tax benefits from the tax treaty, as some states start their income tax calculations with U.S. federal taxable income. So presumably, if your business is conducted in a state that starts its calculation with U.S. federal taxable income, and your business is not required to file a U.S. federal income tax return, or can file a nil federal tax return under the tax treaty, your state income tax return would start with your federal taxable income of 0. So in essence, you're not required to file a state tax return. You must review the rules of each state you're doing business in to determine if you have an income tax filing requirement, as not all states take this approach. The U.S. does not have a federal sales tax. Each state, and in some instances, even localities or municipalities within a state, administer the sales tax. There is no tax treaty protection for sales tax. In addition to sales tax, a foreign company may also have filing obligations for some other state taxes, such as gross receipts taxes and tangible personal property taxes. Throughout our presentation today, we will talk about Nexus, but we don't want you to confuse it with the Nexus program that helps you cross the border more quickly. The Nexus we are referring to is the amount or degree of activity a business can conduct in a state before it is subject to a state's taxing jurisdiction or power. The level of activity differs by state and by type of tax. As I said earlier, the standard for determining Nexus before June of 2018 was physical presence. Here are some examples of activities that create Nexus through physical presence. The use of employees, representatives, or independent contractors to sell, install, or repair products in a state. We've seen many instances when a Canadian company sends either its employees or hires representatives or subcontractors in the U.S. to conduct these activities. For the most part, the Canadian company is protected by the U.S.-Canada tax treaty and does not have a federal income tax filing requirement. However, as I said earlier, treaty protection does not apply to sales taxes. In addition to employee activities, owning, leasing real property or tangible personal property in the state will create Nexus. A typical example we find is someone will rent office space for their sales office. Another activity we see quite often is owning inventory at a third-party warehouse or having consigned inventory at a customer store or warehouse. Companies selling through the Fulfillment by Amazon program would have a physical presence in any state in which their inventory was stored in an Amazon warehouse. Once you provide Amazon with your inventory, they're free to move it to any of their warehouses. They're also quite good at tracking this inventory and can provide you with location of your inventory at any time. Businesses conducting any of these activities would definitely have a sales tax reporting requirement and possibly state income tax as well. We have assisted many Canadian companies that have discovered they had a state sales tax obligation after doing business in the US for years. Sometimes their chartered accountants will discover this, or the company figures it out on their own, but most states they're doing business in will find them. So for sales tax purposes, physical presence is a pretty low bar, and it's quite easy to be physically present in a state. For state income tax purposes, some physical presence is allowed, and I'm going to go over that in a second. But what I want to do is circle back to U.S. income tax and the treaty, and before I hand this over to Tom to talk about economic nexus. Over 60 years ago, to prevent the states from unfairly taxing businesses located outside of their state and selling within their state, the U.S. Congress passed a law in 1959 that would prevent unfair state tax practices. Unfortunately, the law did not provide a lot of guidance, as Congress wanted to get something passed quickly to address the matter, and then they would come back to it later when they had more time to look into it. It's been over 60 years, and today Congress has not passed additional legislation to address this matter. The law itself is pretty brief, basically 2 paragraphs that said a company could solicit sales for tangible personal property in a state without having a state income tax filing requirement. That was pretty much it. So keep in mind that this law only applies to taxes based on income, to businesses that only activity within a state is solicitation of sales, which is narrowly defined by most states to a very limited activity to make a sale. And then lastly, it only applies to the sales of tangible personal property. So it does not protect the sales of services or digital products that are sold in the state. You got to think this law came into effect when we really didn't have any digital projects. So everything was tangible. Physical presence is still required for states to impose their income tax. The U.S. Supreme Court ruling last June did not change this, as it was a ruling on sales tax only. Tom is going to talk about the Wayfair case that was ruled on by the U.S. Supreme Court last June that has now given states the green light to use economic nexus as the test for sales tax.
Thanks, Andy. It's hard to believe it's been since, what, 1959, you said?
Before I was born.
Yeah, well, really? Since Congress looked at that. And, I think it's important that things are shifting on the income tax side, too, because you see more states going with those gross receipts taxes. Like Washington has that business and occupation tax instead of a net income tax. Ohio has, the commercial activity tax, the CAT. So states are getting away from the income tax, and they're kind of skirting Public Law 86272 now, right?
Yes, and Las Vegas also adopted a similar kind of gross receipts tax a few years ago, and Oregon just recently passed legislation.
Yeah, I mean, I think we're gonna see more of that, and I think the shifting in the landscape from tangible personal property to, businesses are selling services, digital goods, none of which are protected. So maybe we'll see an update in that sometime soon.
I believe so.
Hope. Well, what I'm going to talk about today is what has changed. Andy talked about physical presence, and now we have a shift to economic presence for sales tax nexus. This all came down about a year ago, actually. It's going to be anniversary next week, June 21st. And for me, being in the sales tax profession, it's hard to believe it's been a year. given all the changes that have gone on across the country and that are still going on regarding sales tax nexus. So I'll save everybody the gory details here of how we got to this point. Really, what you need to know is back in 2016, the state of South Dakota enacted legislation basically changing to an economic nexus standard for sales tax purposes. Essentially what they said is, we don't care about physical presence. If you have economic activity in our state generated through sales, you're going to have nexus and you need to register and collect. So this worked its way up through the South Dakota court system and ended up in the Supreme Court of the United States. And after some really heated oral arguments back in April of 2018, the court in a 5-4 decision ruled for South Dakota, overturned the physical presence standard, finding it unsound and incorrect. And it's kind of shocking. The court really negated their decision in Quill 25 years earlier, saying, you know, I think we made a mistake. And I think the court, I mean, Andy, if you remember back in '92, I was still in high school, so I don't. But, you know, I don't think the court was very happy back then with the Quill decision.
No, and digital products were just coming out back then. So
yep.
That stuff was in its infancy, but, you know, clearly showed that there had other application not many years later.
Yeah, and there was no internet. I mean, the internet was really just starting to take off as a sales channel for businesses. So what happened was, with this decision passing, it effectively created new sales tax filing requirements for remote sellers. And we'll get into what a remote seller is in a slide or so. And the unfortunate thing about this, it left the filing requirements up to each state. So there is not one single standard. Basically, the court created chaos that day, letting the states pretty much do whatever they want. So you can see here quickly on this chart that we put together the differences in nexus between physical presence and economic presence. Back, the old case before June 21st was dictated by Quill versus North Dakota from 1992. And basically, like Andy said, you had to have employees or contractors, reps, own some kind of property or inventory in the state before you would have nexus for sales tax purposes. And you were protected by that Supreme Court case. So the states couldn't go willy-nilly trying to affect nexus and try to create new crazy theories to drag businesses into the state. Now, with the South Dakota versus Wayfair, and I think everybody knows who Wayfair is, they're the online seller of furniture, home decor, furnishings. They were one of the main defendant in this case that took it all the way up to the Supreme Court. What we see now is nexus equals economic presence, and that just means sales. Now, if you exceed certain thresholds, and for example, with South Dakota was $100,000 of sales or over 200 transactions in the state, you'll have nexus and need to register for sales tax purposes. And the key thing here is there are no federal protections right now. The states can pretty much do what they want as long as they kind of keep it, you know, similar to what South Dakota initially legislated. Congress can always step in and they can make a federal standard. Congress in the US has the power to regulate interstate commerce. We didn't see them do anything with income tax since 1959. They didn't do anything since 1992 when the Quill decision came out. So I don't expect them to step in anytime soon and kind of change things or do anything now. So I guess the question is for a lot of businesses is, now with this change, do I need to collect and remit tax on my sales to US customers? It's a big question. And we go back to what is a remote seller. And a remote seller is generally any business that sells tangible personal property or services for delivery into a state using either the internet, the mail order, or telephone, and that they don't have physical presence in the state. So that could be just about anyone, anywhere in the world, because the internet, mail order, I don't know who uses mail order that much anymore, or the telephone are primarily used to conduct business these days. And it doesn't mean that you have to be an online seller, selling from an online store. I mean, you can, if somebody sends you, a purchase order through email, it's using the internet these days. So you're kind of stuck. And what we've been trying to tell our clients, especially our clients, who aren't primarily internet sellers, is this affects you. This affects all businesses. Because if you're not selling by internet, mail order, or telephone, really the only other way you're going to sell is by being at your customer's location, and that's going to create physical presence, which will create Nexus. So you're pretty much a remote seller. Now, you have to meet certain filing thresholds. In the South Dakota versus Wayfair case, the standard that South Dakota employed was $100,000 of sales in a calendar year period, or 200 separate transactions. And by separate transactions, you can say invoices. Every invoice you issue to a customer in that state. Now, the problem with the 200 separate transactions is if you're a high volume, low dollar type seller, well, you may get to that pretty quick. You're averaging $10 an order, $2,000, and guess what? You have Nexus and you have to collect and file. So it's kind of a tough get there. I mean, I have a couple clients who don't exceed 100,000 in sales in certain states, but they're way over 200 transactions, and it's really hard for them to get that they have to register and collect tax there. It doesn't seem fair to them. So generally speaking, we know you're a remote seller. You may be over that filing threshold. Is what I'm selling taxable or not in that state? And again, like the filing thresholds, the states don't have a uniform answer for that. Each state imposes its own rules, regulations defining the taxability of property and services. So for example, here in the slides, I've shown clothing. And I've used 3 states, California, New York, and Pennsylvania for an example. California taxes clothing. Pennsylvania does not. And then New York is kind of a hybrid, of course. We exempt clothing, costing less than $110 per item from state sales tax. Now, each county can opt in as to whether or not they tax or exempt clothing. And I think, Andy, in New York, there's like 4 that actually exempt it. So the other issue here is whether you're making sales for resale or other types of exempt sales. If you're a manufacturer who primarily sells to a wholesaler or distributor, your sales are for resale. They're not subject to tax. That person you're selling to, that distributor, is going to move that down the line and sell to an end user or to sell somebody else. Collecting tax is their responsibility. But the only problem with that is you need some documentation to prove that your sale is exempt as a sale for resale. You need to collect a resale certificate from your customer if that's the case. And it's not always easy. Some states have their own resale certificates. There's a multi-state certificate that covers about 30 states, I think. But you need to get some documentation from them, and it needs to be complete and valid, and you have to understand what you're asking for to get that. Because if you don't collect those resale certificates and a state comes in and audits you by chance, you could possibly be on the hook for the sales tax on those sales. You may have an opportunity to go back to your customer and get that documentation, but what if that customer is sold? What if they went out of business? What if they're just being really difficult and won't provide it? Then you're going to be paying somebody else's tax, and that's really, really a tragedy in these situations. So back to the thresholds that we talked about. Of course, each state has their own threshold, and on the handout that Sarah's going to email folks, after the webinar, we kind of list the different thresholds by state. Now, of course, things change. We try to get it as up to date as we could. I think up to this week we were even making changes to it, but things are happening so fast and furious that you may want to consult a tax person or professional, or check the state's website to see what their actual threshold is today. Not all states have decided to use the $100,000 of sales or 200 transactions like South Dakota. And yeah, I mean, it's a huge pain, but at the same time, it makes a lot of sense because $100,000 of sales in South Dakota is not the same as $100,000 of sales in California, New York, Texas, states with large populations and a big economic market. So thankfully, some of these states are actually realizing that. You know, as of right now, I think we have, what, 32 states that are about $100,000 of sales transactions. $100,000 of sales is their threshold. There's a couple in the $200,000 to $250,000 range. Our state here, New York, is using $300,000 of sales and 100 sales transactions. So basically what New York is saying is, yeah, you may have a few large sales, but unless you're over 100, it's not going to get sales in total. It won't get you over the threshold. So that's kind of helpful. And then thankfully, the large states like California and Texas have gone with thresholds of about $500,000. Another issue you have to look at, in addition to the actual threshold, is when did it take effect? I mean, New York is saying their threshold is retroactive back to June 21st, 2018, when the case was decided. Whether the state's going to enforce that all the way back, only time will tell. But we have states that have effective dates ranging from July 1st of last year all the way through November 1st of this year. So you really need to look at that effective date because that may impact what you're going to do and when you're going to register or need to register. Another huge issue that we've been sorting through for the last year is, what is the threshold based on? You're saying $100,000 of sales, but what kind of sales? Is it gross sales, including your taxable and resale and exempt sales? Or is it something else? And some states say, yep, gross sales, everything counts. $100,000 of sales, we don't care. That's the threshold. Some states are saying taxable. Some are saying retail sales. And retail sales are all sales except sales for resale. So you really, really need to look closely at these thresholds and what they're composed of. Some states will say if you have $100,000 of sales, you're over the threshold, but if they're all sales for resale, then hey, you don't have to register. New Jersey wants you to register, but then they're going to give you an exemption certificate to say you don't have to file returns. So it's kind of all over the place. There's also some state-specific issues that remote sellers really needed to take into consideration when filing their sales tax, considering their sales tax filing obligations. Like we talked about earlier, if you have physical presence or had physical presence in a state, then simply registering may not be a good option for you. Because a lot of times the states will ask, when did you start doing business in our jurisdiction? They want a date. And they're going to have specific questions on there about your activities in the state. Or they may send you a Nexus questionnaire. So you want to be as honest and forthright as possible to avoid any issues in the future. So if you were in that state before the effective date, or you had physical presence, you may need to consider doing a voluntary disclosure, kind of coming to the state anonymously, asking for forgiveness, remitting prior tax, and then promising to be a good taxpayer going forward. Some states have amnesty programs. They're few and far between these days, but I think we're going to start seeing more of them. So those are just some other issues you need to consider. And just, to let everybody kind of know in general, every state out there really has some type of economic nexus right now, except for the 5 states listed here. Florida, Kansas, and Missouri, they have proposed legislation in their state houses right now. I think Florida may have gotten a little lost up there right now because they have some issues. Kansas and Missouri have issues with local taxes kind of holding things up. Massachusetts and Ohio previously passed cookie nexus, basically, it's a type of physical presence nexus. If you have a cookie on your computer, or if you have an app on your computer, or some type of software. So they're kind of holding firm to that right now while still trying to figure out what they're going to do moving forward with economic nexus. I would expect, though, by the end of 2019 that pretty much every state is going to have something in place. And then finally, just, you know, the heads up, there are 5 states in the US that don't impose a sales tax: Alaska, Delaware, Montana, New Hampshire, and Oregon don't have like a statewide sales tax. Alaska actually does allow localities to collect. I filed returns in Sitka, Alaska for one of my clients before. So you call one guy out there when you can get them, because it's a time difference, and you work it through with them. One other thing I wanted to touch on here that Andy discussed earlier was, what if I have inventory in a third-party warehouse or fulfillment center? i.e., I'm using Amazon, fulfillment by Amazon, FBA type service, where, you know, I send my inventory to them, and then they handle all the fulfillment type services. Well, you may not need to worry that much about Wayfair and the economic nexus thresholds, because you're already got to have a physical presence in those states where the inventory is. That's already going to trigger nexus for you. You know, it can be confusing, and I think a lot of our clients thought, okay, well, physical presence is gone now. It's just not the be-all, end-all that it used to be. It still creates a filing requirement for businesses. Physical presence still creates nexus. The economic presence now is just really another arrow in the state's quiver to get you. So if you have inventory in those warehouses, you may have an issue. You really need to look and find out where that is. Because one of our clients recently, small business selling candy, they ship inventory to Amazon. She was shipping it to one warehouse primarily and thought she was good. That was it. Well, we looked at it more closely, and we could tell that Amazon was moving that inventory to about 20 of their other warehouses across the country. So now she has physical presence in all those states, and it's something we need to address for her. Some states do, I think, well, New York might be the only state that still provides a fulfillment services exemption. If you have inventory in a warehouse in New York, only for the purposes of, someone providing fulfillment services, then that's not going to create a nexus for you. But it's unclear whether the new economic nexus threshold will supersede that. That if you may have inventory, but if you're over the 100 sales and $300,000, whether or not that's going to create nexus. And like Andy said, too, having that inventory in the state is going to possibly create an income tax filing requirement. The one thing I do want to mention that I didn't put on the slide, because I didn't want to overly confuse people, was marketplace provider, marketplace facilitator issues. A lot of states don't want small businesses to register. It's a huge hassle to have tens of thousands or thousands of businesses filing $5 returns a month, a quarter, if not lower, register. They're overwhelmed. And I talked to the Maine tax department a few weeks ago, and those poor people didn't know what side was up. So what a lot of the states are saying is that if you're a marketplace facilitator like Amazon, where you're facilitating a sale for a third party, they want them to collect the sales tax. So right now, Amazon collects tax on third-party sellers' behalf in about 15 states. And by the end of the year, that's probably got to shoot up to about 25 states. So that is something to consider, that while you may have that filing obligation, Amazon may be collecting that tax for you. It's really a more complicated issue than we have really time for today, but I did want to mention that, just to let everybody know that's out there. So really, to conclude, my part of this, before we get to some questions, hopefully, is what are the next steps? What do you as a Canadian business do now, to move forward and comply with these new U.S. sales tax filing requirements? Well, I mean, number one, you really need to review your sales and business activities, before and after the Wayfair decision, to see where you potentially have Nexus and filing obligations. If you had inventory, or if you have physical presence in a state, it's got to create some issues for you. We want to look at our taxability of products and services and see whether or not I should be collecting tax. And if I'm not, if I don't have to, if I'm selling for resale or my product's exempt, well, do I have my resale certificates? If you're anything like my clients, the answer is probably no. Yeah, you really need to go and get them. And then, this is new. This is very new for a lot of businesses. Our system's very different than the Canadian system. So you may need to develop a plan for this compliance and how you're going to handle it. You need to hire people. What kind of technology do you need? You want to just outsource this to somebody? What's the cost of all this compliance? And then once you figure that all out, it's time to decide whether or not you want to register, and move forward and be, in compliance with the state tax laws. And then don't forget too, you always want to monitor what's going on. As changes, like I said, are moving fast and furious with this. So that's just a summary. I think we have our next steps listed on the download too, Sarah. So you'll be getting that in the email.
Sounds good. Yes, we will be. So thank you so much for your expertise today, for putting the information in more of an understandable setting for everyone. I think it kind of explains it in an easier way, makes it sound not too complicated, especially for those that might be organized enough to collect those documents ahead of time. So we are going to go ahead and take some questions. So be sure to type them in your question box in your control panel. And one of the other options in our next steps and on the back of our handout that you will get is considering a physical presence. And so before we move forward, and while our audience is submitting questions, I just want to briefly speak to you about the idea of expanding your Canadian business to the U.S. Invest Buffalo Niagara has been in existence for 20 years now and has helped over 100 Canadian businesses in those years expand here to the Buffalo Niagara region. So why? Well, most often than not, businesses like you, our audience, are already doing business in the U.S. and decided it was time to reduce the risk to their Canadian headquarters and separate that U.S. company. In addition, other factors added to their decision, like the Made in the USA label, reducing the cost of doing business, and border issues. Companies choose the Buffalo Niagara region for its close proximity to the Canadian market and also its large U.S. market within the 10-hour drive, for its workforce and for its low-cost power. Well, how can Invest Buffalo Niagara help? We have a team of business development representatives who have assisted these companies and can assist you free of charge and highly confidentially. We help with cross-border due diligence, site search, the incentives process, and we set up meetings with our partners like Tom and Andrew, as well as other accounting, law, HR, and utility companies. If you've participated in past webinars or receive our emails, you probably know who Carolyn is. She leads our international team, and if you do not know who she is, you can go to our website and connect to her and the team through our website via email, phone, or even schedule a phone meeting. As Tom mentioned, you will receive the follow-up email with documents to assist you with the topic today, but you can also access additional materials on our website, including a few very in-depth expanding to the U.S. guides. And we continue to share useful tools monthly from our partners, from our expert teams of expanding to the U.S., and you can get those updates through our newsletter if you want to stay connected. All right. So it looks like we do have a handful of questions. So let's get started with our Q&A. The first question looks like would be for you, Andrew. In Canada, there are input credits for sales tax. Is that the same in the US?
No, the US system is a little different than the Canadian system in that the US state tax, sales tax system only tax the end user, the last person to take possession of that product. In Canada, there's sales taxes along the way, which get accounted for by taking an input credit when you're going to pass that product on to the next person or resell it or whatever you're going to do with it. So that is the largest difference between our system and theirs. We just tax the end user unless you have an exemption.
Great. Okay, another question, I believe for Tom. Does visiting an existing customer, not a new customer, qualify as maintenance activities, or is it exempt from Nexus sales use?
So if you were to visit a customer in the US at any point, that would be sufficient to create Nexus for sales and use tax purposes in that jurisdiction. Whether you're going there just to solicit sales or you're going there to maybe do some work, whether it's installation, maintenance, repair work, that's going to be enough to create Nexus for sales tax purposes. The actual maintenance work you might be doing, if you're actually doing maintenance, whether it's taxable or not, kind of depends on what's being maintained in the state in question. So it also, Andy, would create an income tax issue too if you are actually doing work.
Yeah, again, when we talked earlier, for income tax purposes, you're allowed to solicit sales, and solicitation of sales is very narrowly defined by the states. So when you start to do something besides soliciting a sale, such as fixing something, you've tripped up yourself for income tax nexus.
All right, so this question on the same topic words it a little differently. If we have customer-owned product in our Canadian operations for an American customer, are we subject to Nexus or state taxes on the sales to that customer?
If you have maybe customer's product up in Canada?
Yeah, that's what that is. If you have customer's products up in Canada, that's not an issue.
Yeah.
For you.
For you, yeah.
If we have an independent contractor or franchisee locally, but are using a central site from Canada, and we collect state tax and remit to the contractor for payment, does that work, or do we have to submit directly?
Well, I think essentially what they're saying is they're getting invoiced and they're paying sales tax on their invoice. That should end the process for them.
I would agree.
If we get sales exemption forms for each customer, are we required to pay Nexus tax?
No, if you're getting exemption forms from each of your customer, whether it's a resale certificate or other exemption type certificate, then you wouldn't have to charge them sales tax on those sales. Whether or not you need to register in particular states if you're over the threshold kind of depends on whether or not whether gross, what definition they're using for the threshold. Is it gross sales or something else? You know, again, it's a decision. It's a tough decision to make. In some cases, if all your sales are exempt, do you still register in a jurisdiction?
Okay.
I mean, one of the advantages to going forward with registering is we have a statute of limitations. So even if you're registered and you're filing 0 returns, it prevents the state from going back further on you than 3 years, at the most 4 years. We'll run into problems is if you've never registered, if you've never filed a return, 10 years from now you get audited, the state can go back 10 years. And if you don't have all those resale exemption certificates, you could have a problem.
Okay, so we have quite a few questions coming in. We're going to hang out and answer a few more.
Sure.
So take your time answering.
Sure.
And so another one, I think this is an easy one. Does Nexus filing thresholds apply to manufacturers as well?
Yes, they would. It's all types of businesses are subject to these. If you're a remote seller, again, whether your product's taxable kind of depends on who you're selling to. You're selling directly to someone who's using it or to a wholesaler. But yeah, I mean, it's, you know, that's the thing. Even our clients don't quite get that here in the U.S. We're having a hard time explaining that to them. I keep getting the, I don't sell online. you know, I don't have an internet store, but yeah, I know, but you're still a remote seller. So.
And not all states, or not, I shouldn't say not all. There's a few states that do have a partial manufacturing exemption. So even if you are selling to a manufacturer, you could end up paying tax on some of the stuff, things that aren't used for resale, such as equipment.
Okay. How long are the resale certifications good for?
Typically, if you get a valid resale certificate from a customer, as long as their information doesn't change or your information doesn't change, name, address, federal identification number, account number, those resale certificates can last indefinitely. You know, typically you would want a blanket type certificate that covers all purchases. In that case, there are a couple states, Florida, right?
Yeah, Florida, Michigan, where it's only a 3 or 4 year, you have to renew it.
Washington too. Florida's every year,
yeah,
actually. Yeah, Washington's like that too.
What we do recommend to our clients, though, is try to renew a third of your resale exemption certificates every year. So every 3 years you turn them over, and what that does is that takes out those companies that were sold where it's no longer valid. You're still shipping to the same name and address, but unaware that there's been an ownership change.
That's a great tip. Underwhelming, but good tip.
And the other thing too with that, like, you know, we advise our clients, like, you know, back in the days of physical presence, we may have said, okay, you don't have physical presence in that state, but still get that resale certificate from that customer. And I think that goes the same now. You may not be at $100,000, or you might not be over a threshold. But you don't know what's going to happen in the future, and it doesn't hurt getting that piece of paper and putting it in a filing cabinet or scanning it and keeping it online. It's some form of protection you have.
So this question came in probably early on. We're a very small service provider and all work online, no physical presence in the US. Do we need to worry about this? And I think I can answer that.
Yeah.
Yes, we do need to worry about it. We are a wholesaler seller, and we sell inventory from Canada to Ohio and Michigan, and we are tax exempt. Is it correct?
You're not necessarily tax exempt. You can get a resale certificate for those products, but now it's still a matter of,
well, if they're a wholesaler and they're selling to
end users, you're not tax exempt.
Yeah. Maybe if you're selling to a manufacturer who is using a part in production, you can get an exemption certificate. But yeah, I think in that case, you definitely need to consider what Michigan and Ohio are doing.
These questions are getting tricky. Do we need a sales tax certificate if we purchase goods in the US for resale in the US, but are below the threshold?
I think it's going to depend on the person you're buying the goods from.
Yeah, the vendor may ask you for one.
Yeah.
Which, we do run into that, and it gets a little complicated because you're not registered, and you, in most instances, cannot issue a valid resale certificate. Yep.
Another manufacturing question. Is selling manufacturing equipment to a US manufacturer on an FOB Canada basis, and the buyer is clearing customs, a scenario that I have to be concerned with regarding the sales tax registration?
So it sounds like in this instance, you're selling equipment to a US manufacturer, titles passing in Canada, so the risk of loss becomes the purchasers in Canada. That sounds like a Canadian transaction.
Right.
But you know, it's hard to answer some of these without all the sales tax can be so persnickety and have so many issues with it that something that's seemingly innocent like that could have other issues.
Yeah, I mean, as long as you don't have some other thing going on in the U.S. such as physical presence, if you didn't visit that manufacturer to help them design the equipment or map out what they need, so you've never been in the plant, you've never stepped foot in the state where it's going to end up, that's not a problem. In addition to having it transfer in Canada, you can ship via third party into a state, and that's not considered Nexus because that's not as long as you're not shipping it in your vehicle, you can use a third party carrier to ship it down here.
If we pass a threshold during the year, at what point are we obligated to register and collect sales tax?
That's actually a great question, and that's something we're dealing with right now for some of our clients who are just hitting these thresholds now in 2019. Most states say once you hit the threshold, you're subject to tax on your next sale, and they typically want you to turn around and register within 30 to 60 days, depending on the state.
Okay. That was a nice question. If we have a salesman in the States who is an independent contractor, does he create a physical presence?
Yes.
Okay, simple. Are state government agencies in the U.S. exempt from paying U.S. sales taxes?
For the most part, yes, they are. There's a blanket exemption for state agencies and municipalities. However, there are a couple states out there that don't exempt state and local governments from sales tax. California, maybe Florida,
North Carolina, I think, as well.
Arizona. I don't know.
That's,
Yeah, but yes, just because you're selling it, you really need to check to see which state it is.
Does attendance at a trade show constitute nexus in that state?
Depends. Most states have specific rules about trade show attendance and the number of days you're in the state and whether or not you're making any sales at that point in the state. So yeah, yes and no, it really depends on, there's certain other factors and each state's kind of different with it.
If I have a U.S. associate that ships from his U.S. location and invoices and collects any state taxes as applicable, do I have to register, or do I simply have to obtain resale certificates from the associate?
I would think not. I mean, that's kind of what we advise our clients is once you set up that U.S. company down here or that U.S. relationship, you're going to ship the product to them. You're going to stay out of the states, and that U.S. entity is going to handle all the sales tax collection responsibility.
Okay, we're going to answer a few more. I assume there's a standard resale exemption certificate. Where do I get that?
You would think there was. Most states want their own specific resale certificate, and you can typically find that on the state tax website. There is, however, a multi-state certificate that about 30 states accept. If you type into Google multi-state tax resale certificate, you would probably get it. It's from an organization called the Multi-State Tax Commission.
Okay, we are a manufacturer. We have a location in the U.S. All of our products manufactured are sent back to Canada for distribution through resellers and distributors. Are we responsible for sales tax in the States?
Well, the sales you're sending to a distributor is something you'd want to get a resale certificate for. Again, you're going to get tripped up possibly on the volume of sales in a state and the state's definition of whether you've got to file if you have gross sales or taxable sales. So it's a state by state matter.
And final question. You mentioned and talked a couple times about product and third-party warehouses like Amazon. Can you elaborate a little more, maybe give one or two more examples? I think this is of interest to our audience.
Yeah, I mean, I think Amazon's probably the big one when it comes to this, is that a lot of people use the FBA to sell their product. So that inventory in that warehouse is creating Nexus for you in whatever state it's stored in. So like we said with Amazon, they like to move the inventory around to make it easier for prime delivery and whatnot, get it closer to the customers. So it would be something you'd have to go into your Seller Central and look for like product movement reports to see where they're moving that inventory to. And any level of inventory in a state is going to create Nexus. So you typically have a filing obligation then for sales tax purposes in that state, irregardless of what your sales are, because you have inventory there. And unfortunately, it's probably going to trip an income tax filing obligation for you as well, depending on the state.
Great. It looks like we've covered all of our questions. We may have missed a couple. We will definitely make sure that we answer those. Thank you everyone for joining us for this hot topic. We appreciate you being with us. And thank you, Andrew and Tom, for your presentation today, your expertise. This was wonderful. Your emails are on the screen too, so people are welcome to reach out to you if they had additional questions or didn't understand or need your help. So thank you again. We hope to see you at future webinars. Have a great rest of your day.